Okay, thank you. First, thanks a lot. I'm Isabella from Brazil. This is Haley from the US and Pratibha from Nepal. We're going to first talk about the foreign leveraging in Brazil, then geopolitics in Turkey, and new trends and role of the state, and finalize with some concluding questions. So, as you just mentioned, the paper argues that companies with secure access to foreign exchange set up offshore financial subsidiaries to have access to cheaper foreign currency financing through the issuing of bonds. So the dualism from the productive side, formulated by authors like Lewis, but Biorchovsky from Latin America and so on. This dualism is reflected on the financial side. So we decided to look at the data from the Brazilian Central Bank, and we found that on aggregate, the external loans of the non-financial corporations are more relevant than the issuing of securities in external markets, and that the issuing has a decreasing trend, including between 2022 and 2023, when there are flexibilizing regulatory changes, like the Marco Cambial, that could have increased the security issuing, but it didn't. And also, we analyzed this cluster analysis by the central bank, that they say that there were two groups of companies that were most of their total borrowing was from abroad. So one of them was dominated by these large companies in the comparative advantage sectors, such as metallic minerals, petroleum, and food. But the other one is composed also of micro, small, and medium enterprises, which may mean that there are some spillovers that are benefiting other firms. Okay. But as she mentioned, the national statistics have some limitations in the case of Brazil, because the usual practice and what the central bank does is to consider the residency over the firm's nationality to analyze what is external debt. And this leads to overlooking the securities issued by subsidiaries abroad. So in this graph, the difference between residency, which is the lower line, and nationality represents the offshore issuance. And in the beginning of the series, this was very close to each other, so didn't matter so much which one you choose, I believe. But after the financial crisis, the global financial crisis, there was a widening gap, so it's important to consider both statistics, and this is what Kaltenbrunner did in her paper. Okay, so then we analyzed the financial reports of these three companies that have the biggest issuances. So Petrobras, that is energy, Vale Materials, and JBS in food processing. So yes, financial reports, they don't say a lot, but they supported the argument of the paper. So Petrobras really does have most of its debt denominated in US dollars and mostly finances its operations through capital markets. It is also a state-owned company, which reinforces the controversial role of the state argument. So it has to attract foreign capital and also support societal needs. And one of the ways that this controversial role was conciliated politically is that, for example, the oil royalties from Petrobras help fund the social currency of Maricá in Rio. So you can navigate this politically. And similar picture for Vale. Here you can see that the securities issued in external markets have a relatively low average interest rate payment. Similar also for JBS. So the question that we're going to do about this section is, what is the weight of offshore bond issuance relative to the total Brazilian foreign debt beyond the data from publicly listed NFCs? And do the positive effects of this cheaper financing abroad outweigh the possible drawbacks? So socialization of private risks, financial crisis, currency crisis, and so on. Now, Haley.
Thanks. Okay, so I'm going to talk a little bit more about the connection of a few of the key findings to recent Turkish geopolitics that I found interesting. So just to reiterate the key findings that are what I see most relevant here, it is, as has been mentioned, that kind of reliance on state guarantees via monetary and fiscal policies. And how this kind of contributes to a paradoxical but rational behavior among firms in holding high amounts of liquidity, but simultaneously large amounts of external debt, and how this is, you know, conceptualized within that kind of international subordination. And so this was the graph that was highlighted in the professor's lecture as well, but just to reiterate, the blue is portion of loans for manufacturing, and then we have the other top 5 sectors that receive foreign capital for loans, or foreign-backed loans. And so we have construction rising pretty heavily over the past years, as well energy sectors are relevant here, and transportation, so keep those in mind for a few slides from now. So what I took away from this was what can be kind of added to this conversation by also understanding how Turkish firms in these volatile contexts also have to react to very volatile foreign policy in addition to monetary and fiscal policy. And dependency theory gives us some avenues for understanding that, particularly through this idea of Turkey as positioning itself as a semi-periphery country within a kind of a spectrum of peripheralization, rather than as a binary with other global north actors. And so 2 key characteristics of states like Turkey operating in this semi-peripheral status is the tendency to retain value in the semi-periphery, so we would see that through the retention of value in Turkish firms, and then value drain from other underdeveloped regions around it, or that the state is involved in. And I think a lot of this can be evidenced by looking at Turkish involvement in Syria over the years. That has obviously changed a lot in the last few months, but has been going on since at least 2016. Turkey has occupied different parts of northern Syria. And with that, it has kind of been expanding what many academics call kind of this expansionist economic nationalism of Erdogan's party. And so we see this in several sectors of the Syrian economy. So the Turkish lira has been imposed in several parts of northern Syria since 2021 and even before. Turkish energy firms essentially operate in a monopoly in these areas. And Turkish firms have also been able to benefit from cheaper inputs in Syria, as well as a substantial role of informal Syrian labor in the Turkish workforce over the years. And I think what's interesting is to see, you know, how that has just multiplied in the last few months, and you know, there's still a lot to be figured out about, you know, kind of this new stage of Turkey's positioning in the region, but overwhelmingly analysis has indicated the way that Turkish firms in particular have the most to gain from this, and from what has been estimated at something like $400 billion of reconstruction costs in Syria. And so we've already seen this through increased stocks in Turkish construction companies that have really been struggling over the years with constrained loan agreements and rising inflation, new energy partnerships as well, and communication around expansion of Turkish transportation in the country as well. And so all of this is not necessarily to, you know, disprove the fact that Turkey is subordinated within this relationship, but to question kind of where it sits within this spectrum. And I think the main takeaways for me were really kind of the way that subordination of neighboring currencies like the Syrian pound can help drive down those input costs of Turkish firms who are themselves burdened by the Turkish lira. Also, a bit ironically, and we can only say with hindsight, but that huge amount of liquidity that's being held to kind of, you know, reduce risks of macroeconomic volatility also becomes a huge asset when new markets open up virtually overnight. And so all of this kind of goes to show, I think, the way that firm behavior in these sorts of places is not only highly dependent on financial and monetary policy, but also foreign policy and interventionism. And so this is a quote, and I forgot to mention it in the previous slide, but the kind of theories on sub-imperialism that this is built from. This is a quote from Claudio Katz from 2022 that I think has just become more relevant now, is that, you know, Turkey is really establishing itself as the main exponent of this modality of serving in the semi-periphery in the region. And so it brings up a lot of questions to how do we understand international financial subordination within these, you know, rapidly changing geopolitical contexts. And so my question is more about kind of what of this was evidenced or not in interviews with Turkish firms. So it was evident through the article that there was a lot of mention of kind of this future expectation and anticipation of macroeconomic volatility, but I would be keen to understand the degree to which there was also either a perception or reference at all to, you know, the way the Turkish state is communicating it is going to make right on those guarantees that it's giving. Is it through, you know, kind of holding the carrot of new markets being open in the future? Is it something else? I think it, yeah, is interesting to know and for kind of contextualizing how things will play out.
Okay. So moving on, I would be talking more about the role of state. The paper discusses that state plays sort of a contradictory role, which the professor also said during her presentation, that they tend to enable access to global financial market while simultaneously also creating vulnerabilities to the country through policies like PPPs or development bank loans. But I wanted to discuss two case studies from India and Indonesia to maybe argue that there is possibility for countries to not play this contradictory role, and hear your thoughts on it. So in case of India, it focuses on developing robust domestic financial markets through masala bonds, which has been introduced to enable firms. Oh, where is it? Hold on. I can't go down. To go down. So the masala bonds has been introduced since 2014 in India, and there you go. Oh, perfect, because I couldn't scroll down, I'm sorry. And it's been on, in the London Stock Exchange as one of the largest bond market. And in terms of its market size, it's second largest bond market after China with 400 billion outstanding values. And as we can see in this graph, even though it's only from 2020, of course, but post-pandemic, it sort of shows a steady growth starting from around 1,000 to 1,500. And it sort of aligns with India's strategy of reducing dependence on foreign currencies and strengthening their domestic financial markets. At the same time, the International Financial Corporation also uses this masala bond to fund infrastructure projects in India. So different infrastructure projects like roads, renewable energy are often financed through these domestic and rupee-denominated bonds. So, of course, with time, say if there's domestic inflation rate that rises or there's different monetary policies that could increase this rate, there is still room for some vulnerabilities to be created. But the case example depicts that maybe the state is not playing a contradictory role per se for now. Similarly, in case of Indonesia as well, they've introduced some macroprudential policies like restrictions on foreign exchange exposure for domestic firms, minimum hedging requirements to mitigate currency risks, and reserve requirements for banks to ensure liquidity. So a lot of reports on Indonesia have also suggested that this policy approach since 2010 has proved superior to the standard inflation targeting frameworks. So the state has been closely coordinating with related agencies to promote financial system stability and further macroeconomic policy and structural reforms. Moving on. Okay. So a bit of reflection on the global trends, the biggest one being the de-dollarization effect. In case of Russia, following the Western sanction, Russia has actively reduced its reliance on the US dollar by trading in rubles and yuan, particularly with China. And also more emphasis on their Eurasian Economic Union that promotes local trade currencies among member states that's the post-Soviet countries. And then in case of China, the Belt and Road Initiative also encourages the use of yuan in international transactions. At the same time, there's been other initiatives like the cross-border interbank payment system as an alternative to SWIFT options. So, so there's been a lot of multipolarity in the present day, especially among the emerging economies, like BRICS, the New Development Bank, or the Asia Infrastructure Investment Bank, who are offering financial alternatives to reduce dependence on the dollar-based system. At the same time, there's been regional financial initiatives, such as the Chiang Mai Initiative in Southeast Asia, and not to forget that the yuan is now the 5th most traded currency globally, and it's also included in IMF's special drawing right basket. So given these preface of the global trends, I wanted to add up to the question, how do you see the concept of IFS evolving for emerging economies in light of recent global financial needs like de-dollarization or rising multipolar financial centers? I mean, of course, it could also create a power imbalance with even among the emerging economies, with China becoming the dominant with their rise in yuan. But still, in general, how does this trend come in fit with case of IFS? So just to revisit, these were the 3 questions that we posed during the presentation. Thank you so much for listening.
Thank you very much. So if you can come back to the floor. That's it. I mean, whatever you want.
Okay. And then, okay, cool. Yeah, thank you very much. These were brilliant and really interesting additions to the paper, and it was really, really interesting to see what you have picked up and what you have developed further. So it's a really nice exercise, and it's a very good idea, whoever has come up with this. Yeah! Whoever designed this course, I think this is a really...
It was at the beginning of EPOG when we discussed which kind of original thing we propose to the European Commission.
It's really nice. Really nice. Because it's more than just kind of critically engaging with it and just kind of basically trying to take it apart, but it's take something and let's investigate it further, let's build on it, let's see whether we can find a few more insights. I'm just relieved that you haven't found something different to what we said. I was like, oh my God, is she going to say now that actually we found data which completely shows something different? It's like, oh my God, but at least it was the same. So basically the first, and I only realized in the second question that this is what I had to do. So the first question I haven't noted down so well. So if I understand right, does cheaper foreign financing offset the cost of it, the kind of socialization of debt, etc., etc.? I think this is a bit of a subjective thing, and I think it really depends on the types of foreign financing. And I think there are authors that argue, for example, there's a very interesting paper by Andrew Fisher, who's one of the co-editors of Development and Change. But basically, there are authors and arguments who say that every successful development project in a way required external financing and relied on external financing just because of that underpinning balance of payments constraint. And in a way, what I've showed you before is that, you can finance as much as you want internally, but you have the high financing cost, but also at the end of the day, in order to develop, you will need the inputs, and very often you have to pay them with foreign exchange. So if you don't have that foreign exchange available, or if you can't exchange your currency on the foreign exchange market because it's lower down the hierarchy, it's different. But I think what I would say, it really depends on the type of foreign financing. So I feel quite strongly that I actually think we can probably do very much without any kind of very short-term, speculative, high-yielding forms of foreign financing. And I think particularly, I think Brazil and Turkey, and I think the second presentation kind of hints at that, they're really kind of sub-imperialists and they're semi-peripheral country. We're not talking about the poorest countries. For the poorest countries, I basically think we owe them aid. We owe them grants. We owe them reparations for everything we have done to them. I think for For Brazil and Turkey, this is a little bit more difficult. But I do think that some form of macroprudential regulation to ensure that the financing which is being assumed by private agents doesn't contribute to the macroeconomic stability, instabilities is very important, and in a way that tensions which come out. So I think to directly answer your question, I don't think so. Does cheaper foreign financing offset cost? I don't think so. But under the proviso that, we need to think about what kind of foreign financing we talk about. And I think, and in that sense, I have a lot of sympathy with the MMT policy, in the sense that we really need to strengthen domestic provision of financing. And I think we do need public banks, we need development banks. We just need to make sure that they can operate within the global structures which we're operating in. And I think that's really the key challenge. So I think, I don't know how long I have to respond to this, but one thing we are thinking about in the context of this project on this local currency lending is that, I guess at the end of the day, the key risk is always the FX risk. Who carries the FX risk? And so, if we want to think proactively and creatively about development finance, maybe an institution which takes on some of that FX risk and helps hedging, for example, the national development banks, I think that could be something to think along. So the question is, no, I don't think foreign financing is necessary, but it's good. I think we need to strengthen development domestic financing, but we also need to be realistic about what it can do and what the limits are and what else is needed. Does that answer your question? Good. Then, yes. Oh, I have. What is the weight of offshore bond issuance relative to the honest answer is I don't know from the top of my head. We probably have to have a look into the data again, how much. I know that when I looked at it, I also did a consultancy report for UNCTAD at some way back. It was quite high. It was probably around 30-40%. It was significantly. But I think with the recent, financing has become more expensive again, and I think Brazilian firms have become more careful. It has probably declined since, but I think I would have to really look into the data. Thank you. Okay. Then the second comment was about Turkey as a semi-periphery, and I think this is also really, really interesting. It's really nice that you have picked this up, because in a way, in both cases, they're both sub-imperialist. Brazil in its region and Turkey. And to what degree did anticipation of future? Yes. So I think maybe just to reflect on your intervention, which I thought was really interesting, and I think is really interesting in the case of Turkey. So I'm always baffled, because I'm not an expert in Turkey, and I think maybe people don't know more. But from an economic point of view, they seem to have been doing awfully for years. They have massive structural current account deficits. They can hardly afford the imports. They have huge inflation. People are really unhappy. But Erdogan, are the elections democratic or not? I don't know. But one thing that Erdogan seems to be doing really well is just he is a skillful geopolitical player, and he really plays Turkey's role in this Middle East conflict, in that conflict, and extremely well. So he gets the support from all kind of sides which prop him up financially. I will come to your question. But so, for example, one thing we found, or when you look at Turkey, Turkey, because of its really, really weak external situation and its structural current account deficit, Turkey would have run out of reserves years ago if it wasn't for Qatar and Saudi Arabia basically putting dollars into the Turkish central bank. So, there has been a geopolitical, that geopolitical role. Now, has it been anticipated? Elif is the Turkey expert. She has done all the interviews with the Turkish people. I can pass it, the Turkish fund. I can pass this on. One thing I can tell you is that I don't think they predicted Syria, but the sub-imperial role, so Turkey has been very big in Georgia, in other areas, and we know that the accumulation of cash was also related to mergers and acquisition and the internationalization opportunities of Turkish firms. So I think in that sense, you're definitely right. I don't think they waited for the Assad regime to fall to then be able to buy up cheaply whatever is available in Syria. But the sub-imperial role and the possibility to basically build in the periphery of Turkey from the big companies was definitely wrong. And construction is elemental here. Yeah. So I think you put your finger on that. So I can confirm that to a certain extent. Does that answer your question? And the last question was about the role of the state. Yes, and so this is the bigger question, and maybe Bruno wants to come in here later about, so really, what is the future of IFS with the de-dollarization tendencies going on, etc., etc. And I think that's very interesting. So again, I want to preface with a little comment about your discussion on the domestic bond markets, which is also really, really interesting. We've also looked at that. And I think domestic bond market development is definitely better than relying on international finance. It also comes with its issues. And I think you probably know more about this. My sense is that in India and Indonesia, or Malaysia was the second one. Indonesia. At least it seems that these seem to be really domestic bond markets, which are domestic in the sense that you have domestic actors playing in it, institutional investors, pension funds, other forms of players, which in terms of a financial stability perspective is definitely more beneficial. In other countries, for example in Africa, but also in Latin America, you've seen domestic bond market developments with non-resident investors. So you have 40% non-resident investors in the domestic bond markets, which is a recipe for disaster. Yeah, so I think the domestic bond, I agree, it just really depends how you do it. And I think India seems to have been done really well. Right, so what about de-dollarization? So I think the answer I have, again, the honest answer is I really don't know. But my previous sense was always is that I think what we will see is kind of a fragmentation and a regionalization of currencies. So I think the Chinese, what do I know? Okay, I'll tell you my honest opinion and then, might be completely wrong. But my sense is that I think the Chinese are building kind of a more regional monetary space. So I think they're reasonably aggressive and proactive in internationalizing the renminbi in the regions through trade contracts, through settlement systems, through Chinese banks lending in the region, etc., etc. I have the sense that my sense is I don't think they're trying to dethrone the dollar. I don't think they want to become a global currency and take over the dollar, at least not in the short term. My sense is that maybe there was a bit more of an ambition to do that before 2015, where they were quite aggressive with opening offshore centers and, encouraging dim sum bonds, so the issuing of dollar liabilities. But then they had this little mini crisis. They had that little run on the renminbi. They realized, oh shit, we are also a bit vulnerable. And since then, my sense is that the strategy has become a little bit more proactive. Going back to your answer, so I think your question, I think what we're seeing is probably a fragmentation, a regionalization, where we see the renminbi and maybe I don't think the ruble is going to go anywhere, and maybe the rupee in the kind of the Asian space, and maybe a little bit of the real in South America. So, Brazil, again, I think Brazil is not China. Brazil is even more careful about internationalizing than the Chinese renminbi, but, they are doing in this space. The second part of, so I think we see fragmentation and regionalization. The second part of my answer previously was always that I always thought the dollar is going to remain the global currency for international capital, financial capital and productive capital, so that we have kind of this layer so that international finance and international capital continues operating with the dollar, and then we have this regionalization and fragmentation on the second layer without ever challenging the dollar. So the dollar remains that currency for global capital. And the reason why I always thought this is because I fundamentally believe that monetary hierarchy is related to financial hierarchy. And as long as American banks remain the key players and kind of expand, et cetera, that will remain so. Now, with Trump, I'm actually not so sure anymore what is really going to happen. Because I think, there are so many contradictions and things which are on the one hand, on the one hand, he wants to devalue the dollar, which, it would potentially undermine his dominant role, because if there's structural devaluation expectations, on the other hand, this whole kind of agenda of making America great again or putting America first has massively appreciated the dollar. So it's, it's exactly what he didn't want to do. But I think if he really kind of goes introvert and he doesn't support Americans' capital's expansion, particularly his financial system, I think for the first time I'm a bit less sure that the dollar is actually going to remain where it is. I think it depends a lot on the power struggles between, is it called MAGA, and the base and the capitalist in his because he has got these two powers in his government, hasn't he? How these power struggles are going to pan out. Okay.
Yeah, hello, my name is Juan Castillo, I'm from Mexico, and I wanted to ask you if there could be other spatial expressions of international financial subordination, because I find quite interesting when you mentioned at the beginning the uneven spatial development perspective, and then like when NFC is increasing liquid financial assets, meaning cash being withheld in detriment from reinvestment and development capabilities. But how could we think of other spatial expressions of international financial subordination?
Can we collect 3 questions? Thank you so much for this. I'm Jan from Germany. Very interesting to apply this IFS lens to countries that are more in the semi-periphery or like sub-imperial. But I feel it's also a bit more trickier to then explain the dependencies, because often when we are dealing in like countries that were like colonialized, we think of these dependencies inherited from also a colonial period, like the development of underdevelopment. But for example, a country like Turkey that was even at some point the center of a regional empire, it's a bit more tricky. So would you see that in semi-peripheral countries there is not only like this big macro structural explanation of the world system, but also some room for their agency and also then for policy failure? And I have a second question, which is also related to that, is that you were quoting Andrew Fisher at the end with that also every development project needs external finance to also finance imports mostly. Imports of technologies or capital goods. But then the question, I think this just like sidesteps the question a bit, and why do countries then even need, especially semi-peripheral countries, need these technology imports for the West, or cannot they develop some them endogenously? So this would be my question.
Thank you for the presentation. It was very, very interesting. I'm Enzo from Brazil. My question continues in line with the de-dollarization perspective. So it's clear to see that, well, BRICS countries, especially the members that would be mostly benefited from it, Russia in the case of like sanctions, and in the case of BRICS plus Iran. So the last summit happened in Russia, and then they even printed out the BRICS currency or what it would be. So what do you think about the possibility of this happening actually? And then, well, first of all, in my opinion, probably not as a real currency, but also in a second possibility as just a unit of accounting to do bilateral trade.
Maybe we can have a first round of response.
Okay, thank you. Yeah, as expected, these are really, really good questions. Can I just ask one question of clarification? When you say spatial expressions, what do you mean?
Like concrete space, like how does international financial subordination expresses in space, like in concrete spaces?
So examples, or okay. Oh yes, okay, okay. Yeah, that's partly what I want you to find out. This is why we need to have this research agenda, that we know what are a concrete mechanism. I can tell you about, I can tell you what generally has been in the macro literature has been discussed, and then I can give you another example of research I've been doing. But it really depends on the concrete specificities, and I think that's why it's important to look at the specific operations and practices, how they're shaped. But in terms of the general expressions of IFS, which have been discussed, are, for example, this structural interest rate differential, which I've already discussed. So the fact that very often developing countries have higher interest rates, which might not always be justified by economic fundamentals, for example. Another expression is this kind of external vulnerability, in the sense that whenever you have, you have cross-border capital flows, and whenever you have issues in the center, then you have a large withdrawal. So this kind of external vulnerability. And also monetary subordination, for example, what happens to the US. So we see that it's also been discussed as the global financial cycle, right? So this dependence on international monetary conditions in the US. And the fact that actually we're seeing this global financial cycle is becoming ever narrower, so the cycles are becoming ever bigger as well. Another expression is, for example, foreign exchange as a reserve accumulation on a macro level. The fact that central banks, when they can, accumulate massive foreign exchange reserves, which developed countries don't do. The UK doesn't have any foreign exchange reserves. So these are kind of macro expressions. One research which we have been doing, which is a bit of a kind of a meso expression, so we have looked at the foreign exchange structure in Africa. So we did a project for the European Investment Bank, and they wanted to know a little bit more about exchange rate determination in Africa, and we looked at the structure of foreign exchange markets. And what we found there is that because of this, these volatile capital flows and these commodity dependence, one thing that happened is, A, they had very little foreign exchange in the first place. They had parallel foreign exchange markets, they had vulnerable exchange rates. But also what happens is that whenever they had foreign exchange inflows, normally what happens is you have exporters, they export, they get foreign exchange, and they sell the foreign exchange to the central bank or to other banks. And it enters the banking system. And when it enters the banking system, it means the central bank can access it, it can buy it, it can build foreign exchange reserves, etc., etc. In these conditions, or in these countries, very often, because of the fear of the next shock, the exporters, they don't even sell it to the banking system anymore. They sit on it. Yeah, so that means they deprive the banking system of the foreign exchange. The central bank doesn't have foreign exchange. You have the development of a parallel foreign exchange market, and you have a complete inability of the central bank to conduct monetary policy. Yeah, so that was a very concrete expression of how these macro monetary structures fed into the mesostructure of the foreign exchange market and fundamentally impacted the ability of the central bank to do anything. And at the same time, you have got the IMF saying, oh, you have to have floating exchange rates. And the central bank is like, how shall I float exchange rates if my exchange is extremely volatile? I can't really accumulate any foreign exchange reserve to protect myself. So this is one concrete expression. I hope that answers your question somehow. But I really think, I guess this is what we kind of wanted to stimulate a little bit with this research agenda, because the concrete manifestations will really depend on the context, the domestic political economy, the ultimate position in the hierarchy, because things look very different in Africa from Turkey or Brazil, which are these kind of semi-peripheral countries and industrialized, semi-industrialized economies. Yeah. Does that partly answer your question?
Yeah. Like, I'm sure there are plenty other special,
there are.
But yeah.
Okay, then the question about the semi-periphery. I think this is also a very good question. I think, part of my answer is that at the end of the day, I think, at least from a dependency theory perspective, a lot of the countries of the global south are former colonies. It might go a long way, it might go a long way back, but Brazil was a Portuguese colony and provided the raw materials to Portugal and had sort of first establishment of Portuguese banks in Brazil. I mean, Brazil is now a country which has a quite developed domestic financial system, but even those had initial colonial inheritances. On a more general level, even the kind of the colonial story aside, as a matter of fact, a lot of these countries are, if you want, so late-coming developers. They might be late industrializers, they might be late, but they are basically, for a matter of history, they're entering the world market, they're entering the world economy at a later stage, where a Britain, I mean, they're self-destructing, but had already industrialized and had already kind of had the financial system and had the industrial system So, and then in a way you integrate, and you don't only integrate productively subordinate as suppliers, as latecomers, as technology adopters, but you also integrate financially subordinate because you don't have the kind of the financial system yet that's required by capitalism to finance your capitalist, right? And so I think in that sense, at Turkey, you know, the presence of European banks in Turkey is flabbergasting. You've got all, you know, I wouldn't be surprised, I don't know Turkey, but if Raiffeisenbank Austria wasn't on every high street because, yeah, so I think it's colonial, but it's also late-coming development in the sense and adopting, you know, and integrating the financial system, which is already dominated by the core and already has its advantages in that respect. In terms of can they develop endogeneously, yeah, I think they have the potential, but you know, at the end of the day, you also need to finance yourself. You know, industrial development needs financing, and very often you have a domestic banking system, unless it's told so by the state to do so, that doesn't finance industrial development because industrial development is risky. You need 30, 40, 50 years loans, which banks are not doing, and they're doing even less so because you have a rising consumer and middle class, where they can make much more money on credit cards and mortgages than on the long-term financing. And also very often you need the foreign exchange, and I think that's, and I'm not, so I don't think, you know, I think it's very important is that, you know, as post-Keynesians, we don't have a financing constraint, right? We can do everything. We don't need, I think this is really important, and Carsten Köhler has very important work on that. It's not that we don't need the previous capital flows coming in. This is not it. You know, we don't need to finance ourselves. But what we need to be able to do, so we can get the financing from the Domestic Development Bank, but if we want to buy the imports in order to kind of develop our industry, we need, yeah. And I think probably countries will be chipping on it from all kinds of angles. So there's China expanding its regional thing, there's Brazil doing its thing, there's Russia doing its thing, there's Trump self-destructing. So, and I think the BRICS currency is one of them. Yeah, so I think if they could, again, it's definitely an important initiative. The thing which we have seen is when we looked at these initiatives and when we looked at particularly local currency payment systems and attempts, bottom-up attempts to get rid of the dollar, is them too remain fundamentally constrained by the existing macro structures. So you really need a kind of a comprehensive system and development on all kinds of bits and pieces. And as we say in the paper, you really need to kind of simultaneously try to develop all kinds of money functions, we can discuss this later, in order to really promote that. Yeah. So to give you an example, I know this is sounds a bit abstract, but the example I know most about is a local currency payment system. So where in the Mercosur, which is called Sistema Moeda Local. So what the Brazilians and the Argentinians have tried to do is they have to try to get rid of the dollar as a unit of account in their trade relations. Okay, it's a bit similar idea to the BRICS. And it's an initiative between the central banks actually. So and between Lula and Kirchner when the left-wing governments were in power. And I find it an amazing initiative to denominate the trade between those countries in local currencies to get away from the dollar. Now what happens? The Argentinians don't want to have anything to do with this because no Argentinian wants to either receive Brazilian real because Brazilian real is, the sub-imperialist and isn't very stable currency either. And even less so do they want to receive Argentinian peso if they can receive the dollar. Yeah? So, so the whole system has, it basically works as a way of big car manufacturers to do the intra-industry trade. So what I guess, and one of the key constraints, sorry, and then I'll stop, one of the key constraints is on the one hand the macro volatility, so the fact that neither of these currencies are a stable store of value, but it also, and that's where the Minskian argument comes in, it's also because there's zero trade credit in these currencies. So if as an exporter, you need trade credit, right? And the only trade credit available at the moment is in dollar. Why would I want to have my export receipt in real if my trade credit is in dollar? Yeah. So I guess to respond to your question, the BRICS currency is really tricky because it's a geopolitical project. But I'm responding with a different example, which I think is much more concrete. Unless you really kind of tackle the issue from all sides with very explicit state intervention on all sides, the structural constraints are really, really difficult. But it's possible. It's just chipping on it on each side.
Hi, my name is Marina. I'm from Germany. I just have a really short question. You said that you were a quite diverse group of scholars who came up with this research agenda, and I was wondering if there are any scholars who do evolutionary economics. Yes, and if you see their synergies or who those scholars would be. No, yeah, or like more complex, or maybe I have a wrong word, like, yeah, agent-based modeling, complex economics, something like that, yeah.
Yes, hi, I'm Samuel, also from Germany, and you mentioned Minsky, and that's a nice. uh, Not exactly tortured. I'm usually the one that tortures. Yeah. Because I was thinking about how this whole debt story fits into the financial instability hypothesis. And also with regard to what you mentioned regarding the conjunct analysis of assets and liabilities, and also having in mind that I think Kregel also says that Brazil is not exactly the classical Minskin story, and that he focuses more on public debt. And also that there are some criticisms of the hypothesis along the lines of, well, he assumes pro-cyclical leverage, but is that really the case? And is that really, should that be so fundamental to the hypothesis that you have this pro-cyclical leverage in the corporate sector? And well, one way out is to say, well, that's not true. And the other way would be, well, there is something which is pro-cyclical, but it's gross debt, for example. And then you could look at both assets and liabilities going up instead of just leverage. And yeah, I guess my question would be, did you look into whether there are some sorts of cycles that rely either on leverage or on both assets and liabilities, because otherwise it would sound kind of counterintuitive to the classical story. That would be my question.
Yeah, Timon, I'm sorry, also from Germany, so it's now free German question. No, my point is just like for your dollar dependency or like dollar hegemony point, and you're saying like it takes decades. What would you say maybe is the degree of path dependency in there to actually get out of the system? Because we still see like that the financial hegemony will still be in dollar. Developing countries or emerging markets will still have like the external debt in dollar, and that's why like it cannot easily just happen out of the blue that the dollar hegemony is ending. Yeah.
Okay. So in terms of the modeling question, again, my honest answer is that I don't quite know, and my answer will be very ignorant. My sense, and please, Danny, come in if you disagree, because I'm not a modeler. You know this much better. Whenever I have had exposure more to the SFC stuff, is that it was my sense that a lot of these models were still very much driven by real dynamics, and that the financial dynamics we are considering here weren't that present, or at least they weren't the driving factors in these models. So for example, I think, and again, this is ignorance, but we looked at that, for example, when the exchange rate comes in, my sense was that very often it still comes in basically as a relative price, which kind of adjusts the current account deficit and reacts to a current account deficit in order to equilibrate it, rather than kind of some of the financial dynamics which we're discussing. I know there are a few papers by Passarella and Emilio Carnevali who try to get the macro dimension in. So you might want to have a look at those. Whether they kind of get these financial subordination things in. One literature, this sidetracks a little bit, but one literature that has somehow, on the modeling side, I don't know, but that has somehow picked up. The reason I'm mentioning is because it can be quite a model-heavy literature, but please, Danny, you're much more expert than he is. One literature that seems to have picked this up a little bit is the kind of macroecological literature, in the sense that, so, you know, there are papers, and Francisco probably knows more about this as well, by Roman Schwarzman and Althaus, etc., which kind of do look at this monetary dynamics, this uneven monetary dynamics, also in the context of unequal ecological exchange. I'm not sure how much this has found its way yet into their models. I honestly don't know. But there seems to be at least some engagement with that. Whereas from the kind of the more post-Keynesian modeling side, I think there's a lot of sympathy with this, but I'm not sure to what extent they have really incorporated as a driving force into their models. That's at least my sense, but I'm very happy to hear from other people, and you're probably more on the ball with that literature. In terms of the financial instability hypothesis question, so I'm going to give a twofold answer. I think in terms of the Minskian dynamics, so there's quite an extensive literature which has applied Minsky and the financial instability hypothesis to the open economy. And I guess what that literature points out is that this kind of endogenous cycles in a way could potentially be even exacerbated in the open economy because of the exchange rate. So you have these kind of, the cycles could even be stronger because you have exchange rate expectations, and then you have, expansion, the exchange rate appreciates, more profitable, etc., etc. So you have this kind of, and at the same time, the sense that once you include the exchange rate, you have this kind of super speculative units, I think they call them, because of that risk. I think somebody who might have tried to model that is actually Carsten himself, so Carsten Kuller. I think he might have some in structure change and economic dynamics. I think he has a couple of papers where he looks at non-financial corporations. He's another former EPOG, and very good. Yeah, exactly, and now a very much cherished colleague of mine who has looked into these kind of cyclicality from a Minskian perspective through firm behavior. So you might wanna have a look at those. And then the question about path dependency, absolutely. I mean, path dependency is massive, and I guess who knows whether the dollar would actually be the dollar without the Second World War. I mean, and I think this is something we just need to keep in mind. And also, I think this is also why these questions about the future of the monetary system are so difficult, because I just don't think there are any general theories. This is completely conjunctural. When does one empire come to an end, and when does the next empire rise? It's really just looking into crystal ball, and it's a confluence of factors. But as I said, somehow for the first time with the rise of Trump, let's see what he's doing. I kind of have a sense, we might actually see the beginning of a decline, but who knows?
Hi, I'm Arthur from the Netherlands, and I was wondering, in the end of your presentation, you touched a little bit on the type of sectors that were receiving this international finance, and you talked a bit about this difference between like the comparative advantage firms or the technological frontier firms. And I was wondering, if you then create such a public finance infrastructure, how would such an infrastructure then function? Should they only focus on financing comparative advantage firms or technological frontier firms? Like, what's your view on that?
Hi, I'm Muskan from Pakistan. This might be a bit off topic, but I'd like to know your thoughts on this. So given the structural power of finance and the IFS in the context of the ecological crisis, we see rise of instruments like ESG bonds, debt for nature swaps, etc. And these instruments kind of act as a constraint, but also as instruments to enable this transfer of value, which occurs from the periphery to south. So how do you kind of see DEEs financing the green transition?
Another question?
Hello, I am Zulfia from Azerbaijan. I wanted to ask, like we talked about the problems and how it functions. So I feel like we, especially young people, take this structure as granted because we see that, okay, this is how like financial sector functions and how things work. Like, for example, like this subordination fact, and like even semi-peripheral countries misusing its power because they just can misuse their power in their region, and it's just how like they can like get more profits or benefits or whatever. So I wanted to ask, like, what do you think can be a ways to change this structure? Like, for example, Keynes' Bancor system, or like, what like do you favor in like a financial system, and what would you like suggest as better alternatives for like most countries, let's say?
Oh, such good questions. Okay. Arthur. So, of course, you know, the easy answer is, or the quick answer is, of course, they should invest in sectors which are on the technological frontiers. Now, I think this is as kind of as standard development scholars, this is what we would say. Because this is where the value added is, this is where the kind of efficiency is, this is where the good jobs are, etc., etc. And I think that still stands. Maybe just, okay, one addition to that and maybe two qualifications to look at this maybe slightly more critical. The addition is that maybe, and maybe just maybe, the climate crisis here is another silver lining in the sense that, you know, the catching up development in established technologies feels so hard and feels so difficult, you know, that in a sense you will always be the latecomer if you don't have the. But maybe the kind of this urgent need for green technologies, technological change, etc., actually opens a space for developing countries to take on some form of technological leadership, which wasn't possible so far. So I'm just thinking here, China and electric batteries and electric vehicles. I mean, it seems they have really taken that market. And so maybe there is an opportunity actually for global south economies to do that. Maybe just two qualifiers, just as a way of critical reflections. I guess the first critical reflection is that sometimes this sectoral distinction isn't actually that clear anymore, because sometimes what looks like a comparative advantage sector is actually highly technological already. Or for example, soya production in Argentina or whatever is highly technological. Yeah, it's in a commodity sector, but actually the content of it has a lot of very advanced technologies and value added, and actually very little labor input already. So I think we'll probably need more than just a sectoral perspective when we look at this. I guess the second question is maybe a transition question, because, and I think that goes back to the development question about, do we need that foreign exchange? I guess even to develop this technology, we will need these intermediate imports to, really, kickstart domestic production, etc., etc. And for that, we will need the foreign exchange, and that will still come from comparative advantage sectors, at least in the medium term. So the question from a purely developmental perspective is, does some of my money still need to go to these comparative advantage sectors as an intermediate strategy? I'm really just answering and questioning. I remember having endless fights with an Argentinian friend who said, look, we need the soya for the moment in order to be able to invest in our other things, because without the soya, we're not going to have any foreign exchange to do anything else. So, sorry, it's not a very clear-cut answer, but I also didn't want to give a naive straight, it's, of course we want high technology. I think we also need to be realistic what is at stake. Yes, so the question about financing the climate transition. So here, I actually have a really, really strong opinion about this. And it's a naive opinion, but I really think this is what should our narrative. Anything that's related to climate finance and climate adaptation and mitigation needs to come as a gift or as a grant. I find it absolutely outrageous, really, that we are in a situation where the periphery, A, has been exploited, B, has to kind of bear our pollution, 3, has to import our green technologies, and 4, has to do this by incurring more debt, which means that they can't pay the expenditure. So I really feel, the more I think about this, I feel more strongly about this, that, all this kind of, and I know this is not realistic, I know this is not going to happen, but, honestly, the narrative should be is like, we owe them the money for free to do what is needed in order to think about this as a global rechanging of the system. Sorry, in this case, this is, the reality will probably be that they're going to put more debt onto these countries, which they can't bear anymore, but yeah. Change structure. Sorry, can you remind me of the last question? Yes, yeah. Okay, so what can we do? I do think, and I come back to this, I think at the end of the day, I'm not sure which currencies on the top of this system is going to make a difference, whether it's the renminbi or whether it's some basket or whether it's the dollar or whatever. I think what we need is, I think we really need sustainable financial development in the countries themselves so that they can finance themselves through a well-functioning, again, call me naive, strongly state-controlled financial system, which directs credit, which kind of makes decisions about, what do we want as a development strategy. And I know the state is complex, I know that, but I think we also shouldn't, that's what we have, This is the kind of what we're operating with. So I really think in that sense, let finance be national. So, develop this domestic financial system with maybe some South-South and regional component into this. So, doing something on the regional level, South America I know best, Africa I know best, having some regional agreements, regional trade agreements, maybe some kind of use of a regional currency to complement national strategies because they are just stronger. I'm not sure whether having another global currency or having a banker system is actually going to change the realities of subordination.
There are a lot of problems to do this because, first, these countries cannot merge at some point because they may also have fights with each other, regional.
I know.
On the other hand, these all countries in the end depend on core countries, and there are very small countries that basically cannot build their own financial system, and they will end up being dependent on other countries. So it's very hard to state-based.
I wouldn't.
Also, the Christian state itself. I'm from Azerbaijan.
Yeah, I know.
It's gonna really be a trusting state only will be a good solution. I'm not sure. Also.
I know. No, I know, but I'm not sure what to say to that. You're right, but I think we also, the hurdles feel so big. But I think we need to. I think the only thing I wouldn't be so negative about is the capacity to use having a national financial, having the capacity to use a national financial system. I think, you know, even if you're small, so I think, you know, using finance for development, you know, in the context of a developmental state has been something that has been used, but has just been completely, you know, eradicated. I think we can do something. What does the state, you know, is the state the trusted? But this is the best we have as an organizational device. No, I really wouldn't know where else to go.
If you allow me, I would have I don't know if Enzo. 3 minutes, yes. So very short question, yes. Since Enzo has already raised his, because I got really interested in the issue related to the multilateral development banks and the fact that at the end of the day they provide loans in dollars, and then how to change it. Because I have been thinking about it for the case of the BRICS bank. And it's really not easy to escape from this dollar trap, because either someone gets the exchange rate risk, then it can be the NDB in this case, or we have it also, because then, as you said, the Brazilian Development Bank sometimes gets this exchange rate risk. Then we have to see who has better conditions to manage the balance sheet in order to, or we have to raise funds in the local currency, which is also not easy, because then we raise funds with high interest rates in the case of Brazil, because then the basic interest rate gives a, so I don't know if you already have a take on that. If you, who would you say that should get the exchange rate risk, or well, I don't know if you have a take on that. Not yet.
Yeah, no, thanks, because this is really what we're grappling with at the moment. Is that the last question? Shall I respond to that, or so, there was? And so you had another.
But to have 2 minutes, is it really quick?
No, I can wait to hear later.
Okay. Yeah. No, but I think this is so important, and I think it's quite good to finish on that, because it just shows you that even if you follow up the ranks, this dollar dependence is still there. And at the end of the day, it's a question, who takes that risk? And I guess our argument with this multilateral development bank project, and because just, you know, and going back to the kind of the path dependencies, in a way, these development finance institutions are just perpetuating this path dependency, because if they continue lending in dollars, you know, they're just maintaining the hierarchies. And, you know, it should be those institutions which should actually start breaking these hierarchies, because there are virtuous cycles as well, no? If you have, I mean, there are massive issues around this, but if you have, you talked about this in the case of India, the IFC goes into India and issues a rupee-denominated bond, right? The IFC has now rupee-denominated liabilities. The IFC is really not going to have an interest that the rupee is not going to depreciate. Now, the IFC is small, but once we kind of, you know, once we start thinking about it that way, there are really vicious circles which could emerge about this as well. So I guess our argument is that at least to a limited or some extent, to at least start, the large MDBs, the World Bank, the IMF is different, the World Bank, the European Investment Bank, the EPOG, the Inter-American Development Bank, they have the capital, they have the profitability to take at least some of that risk. I really think we need to push for that, because they don't say, oh no, but then our credit rating. I think they have to go a long way to lose the AAA rating, because a bit of local currency lending to Uganda, so that Uganda can support its farmers to do climate mitigation. Yeah, so I think this is really important. But the constraints, and I finish on that, you know, the New Development Bank really shows this constraint, because the New Development Bank, because they're lending in local currencies, their rating is a B, and their financing cost is substantially higher, and so the loans they can provide are significantly less attractive than what a World Bank can provide. So, yeah.
So thank you very much.